There's this number that just kind of hangs in the air whenever you even think about buying a house in the U.S. It's become this almost mythical barrier, right? A giant financial hurdle that stops people like before they even start.
20%.
Exactly, 20% down. And you probably hear that, especially if you're dreaming of buying your first home and immediately feel this weight. Okay, you think, where am I ever going to get that kind of money?
And depending on the market you're looking at, we're talking tens of thousands, maybe even hundreds of thousands of dollars.
Right.
It feels impossible.
Genuinely impossible for so many people looking at today's home prices. But here's the thing, the critical twist, the insight this deep dive is really built on. What if that number, that imposing kind of fear-inducing 20%, isn't actually required?
Mm-hmm.
What if the reality of what people are actually putting down, and maybe more importantly, what lenders require, is often much, much less?
That disconnect is huge.
It's massive.
And that persistent belief in the 20% rule, it's more than just, a simple misunderstanding of mortgage finance. It's a significant psychological barrier. It actively prevents people from even pursuing homeownership.
Yeah, they see the number, feel defeated, and just stop looking.
They stop saving with a realistic goal in mind because the goal they think they need to hit is just completely out of reach.
Absolutely. And unlocking the reality behind this persistent myth is exactly what we're diving into today. We've pulled together a pretty powerful stack of sources for this. We're looking at detailed insights from reports like NerdWallet's 2025 Homebuyer Report and the Next Gen Homebuyer Report from National MI and First Home IQ.
Good stuff there.
Yeah, and we're grounding ourselves in hard data from places like Bankrate on actual down payments. We're tapping into practical advice from financial institutions like Burke and Herbert Bank. And crucially, we're bringing in the real-life experiences, the struggles, the sacrifices, the wins shared by hopeful home buyers on platforms like Reddit.
Right. And our mission today is, it's clear and I think incredibly important for anyone navigating the path to homeownership in the current U.S. market. We want to take all this information and really unpack it. We will absolutely separate that stubborn, kind of dream-killing 20% myth from the actual reality of down payments today.
Yeah, let's bust that myth.
We'll explore realistic saving strategies, not just theoretical ideas, but tactics people are actually using. We'll highlight resources like those down payment assistance programs that so many people simply don't know exist. The goal is to give you practical, actionable insights rooted in data and real experience, so you can approach saving for a down payment and the whole home buying process with confidence, armed with accurate, up-to-date information, not these outdated, discouraging beliefs.
Okay, let's unpack this deep dive then. The very first thing we have to confront head on is just how common this idea is, right? That a 20% down payment is somehow mandatory or the only way in. Our sources definitely confirm this belief is incredibly widespread all across the country.
It really is astonishing how deeply ingrained this myth is. According to NerdWallet's 2025 Homebuyer Report, which is pretty comprehensive, a staggering 62% of Americans surveyed genuinely believe that putting down 20% of the home's purchase price is a requirement to buy a home at all.
62%. Just think about that for a second. Nearly 2/3 of the entire population is operating under this fundamental misconception about one of the biggest financial moves of their lives. That's a huge chunk of people potentially getting discouraged right out of the gate.
And here's where it gets really interesting, maybe even more surprising. The myth isn't just confined to those hoping to buy their first place. That NerdWallet report found that even 60% of existing homeowners, people who have actually gone through the process, still hold this belief.
Wow. That is surprising. You'd think their own experience might contradict it, especially if they didn't put down 20% themselves.
Exactly. It suggests the myth is just incredibly sticky. It persists even after you've actually navigated the system.
Wow. So it's not just potential first-time buyers who are misinformed. It's like baked into the general consciousness around homeownership. And what's the direct, tangible consequence of this pervasive, sticky myth? What actually happens because so many people believe this?
Well, it functions as a significant and frankly unnecessary barrier to entry for potential buyers. That same NerdWallet survey found that 33% of non-homeowners surveyed said that not having enough money for a down payment is precisely what is holding them back from buying a home right now.
A third of them.
A third. And if they believe they need this huge, often unattainable 20% sum, they're probably not even exploring their options. Right? Not looking at realistic home prices or investigating actual loan programs that might work for them. This deeply held myth could be unnecessarily stopping them in their tracks, keeping them from even starting the journey.
That's the real cost, isn't it? Delayed dreams, missed opportunities, and a big chunk of the population feeling excluded from a major wealth-building opportunity just because they don't have the right information. And I think it's worth looking at the history, too, just briefly. Like, why does this 20% number even exist in popular culture? And why does hitting that number feel so much harder today compared to, say, our parents' generation?
That's a crucial point for understanding why the myth persists, but also why it's no longer representative of reality for most buyers.
Yeah.
If you look back, say, to the 1990s, a 20% down payment on the average home was roughly equivalent to about 80% of the median annual household income back then.
Okay, 80% of a year's income. Still a lot, but maybe doable.
Yeah, while still substantial, it was, for many households, a potentially reachable savings goal over, maybe 5 to 10 years of dedicated saving.
Right.
Now, contrast that with the situation in recent years. That very same 20% down payment on today's median home price often requires 100% or even more than the median annual household income.
Wow, a whole year's income or more just for the down payment.
The disconnect is stark. Home prices have simply escalated at a pace that far, far outstrips wage growth for the typical worker. So the goalpost, that 20% figure, has stayed the same in people's minds. But the economic reality of what saving that percentage requires relative to income, it's changed dramatically.
It makes the traditional 20% feel not just difficult, but like you said, for many, mathematically impossible in the near term through saving alone.
Exactly. The goalpost hasn't just moved, it feels like it's run off the field entirely, while public perception just hasn't caught up.
That makes so much sense. The number stuck around as the standard, but its real-world burden relative to how people actually earn money has become exponentially heavier. So, okay, if 20% isn't required and it's become so disproportionately difficult to save that much anyway, what are people actually putting down on houses in the U.S. these days? What does the real data show?
This is where the data from sources like Bankrate, looking at actual housing transactions, becomes incredibly insightful and, frankly, myth-busting. When financial experts talk about typical down payments across the market, they often focus on the median rather than the average.
Right. And why is that distinction, median versus average, important when we're looking at down payments?
It's really important because the average can be easily skewed by outliers.
Okay.
For example, if you have a small number of very wealthy buyers putting down, 50%, 60%, maybe even buying with all cash.
Yeah, those big numbers pull the average up.
Exactly. Those few transactions can pull the mathematical average down payment amount up significantly. And this can create a misleading picture, right? Making it look like the typical person is putting down more than is truly representative for most buyers.
Got it.
The median, on the other hand, is the middle value. If you lined up every single buyer's down payment from smallest to largest, the median is the one exactly in the middle. It gives a much better, more representative picture of what the typical borrower is actually contributing.
Okay, that makes sense. Median gives us a better sense of the middle-of-the-road experience. So looking at this data, what is the median down payment on a U.S. home right now?
According to early 2025 data from ATTOM, which Bankrate cited, the median down payment on a U.S. home purchase was $54,310.
$54,310. Okay, let's be clear. That is still a significant amount of money. Saving that is a major undertaking for most households. Absolutely no question.
Absolutely. Nobody's saying saving for a down payment is easy. But when you look at that $54,310 median down payment in relation to the median sale price of a home at that same time, which was around $362,000, that $54,310 represented approximately 15% of the sale price.
15%. Okay, so even the median down payment across the entire U.S. market, the middle point for everyone is below that mythical 20% mark. That is a crucial data-backed point right there. Directly contradicts the widespread belief.
Exactly. It immediately shifts the perspective, doesn't it? And it's also important to note that the median down payment amount, the dollar figure, it actually increased by about 10.8% year over year leading up to January 2025.
Okay, so the dollar amount went up. Why?
Well, it isn't necessarily because people are putting down a higher percentage. Rather, it reflects the direct impact of rising home values.
Ah, right. If homes cost more, 15% of that higher price is just a larger dollar figure.
Precisely. It shows the goalpost amount is rising, even if the percentage isn't hitting that mythical 20%.
Okay, so the dollar amount required is going up because house prices are going up. Makes sense. Now, does that median figure of 15% hold true for everyone? Or does it vary, say, depending on whether you're a first-time buyer versus someone who's bought before?
Oh, very significantly. And this distinction is incredibly important, especially for anyone listening who's dreaming of their first home. According to 2024 data from the National Association of Realtors, which aligns with these overall trends, repeat home buyers, people selling one house and buying another, they tend to put down substantially more.
Okay.
Their median down payment was around 18%, which makes sense, right? It aligns with that overall 15-ish% median we just talked about, because repeat buyers make up a big chunk of the market, and they often leverage equity from their previous home sale.
Right. Using the profit from selling their last place to fund a bigger down payment on the next one. Makes perfect sense.
Precisely. But here is the absolutely key number, the one that should really grab your attention if you are a first-time homebuyer.
Okay.
First-time homebuyers have a much, much lower median down payment. That figure stands at around 9%.
9%. Okay, that number is incredibly powerful in dismantling the 20% myth, specifically for people buying their first home. It shows that putting down less than half of that traditional daunting figure isn't just possible. It's actually pretty common. It's representative of the experience for typical first-time buyers.
It fundamentally reframes the savings goal, doesn't it? Makes it feel far more achievable. Instead of thinking, oh my God, I need $80,000 for a 20% down payment on a $400,000 home, a typical first-time buyer, looking at this data, might be aiming for, $36,000 based on that 9% median?
Still a significant challenge, obviously. Requires discipline, planning.
Absolutely, but dramatically less daunting than $80,000.
For sure. And the bank rate data also showed that the down payment amount tends to vary quite a bit by age, right? Which probably reflects different life stages, accumulated wealth.
Yes, there's a clear correlation there between age and the size of the down payment percentage. Generally, younger buyers, folks earlier in their careers and savings journey, they tend to put down less.
Makes sense.
Probably because they've had less time to accumulate significant savings, and they typically don't have the proceeds from selling a previous home to, inject into the purchase.
Yeah.
As buyers get older, the median down payment percentages increase pretty dramatically.
Let's run through those age-based median percentages from Bankrate. What did they find?
Certainly. For home buyers aged 26 to 34, the median down payment is 10%.
Okay, 10%.
For those aged 35 to 44, it rises a bit to 14%. Buyers aged 45 to 59 see a median of 17%. And then you see a significant jump for the older age groups reflecting, later life financial positioning, maybe downsizing, selling assets.
Right.
Ages 60 to 69, the median is 28%. Ages 70 to 78 is 36%. And those aged 79 to 99 have the highest median at 38%.
Wow. Those higher percentages for older buyers really underscore the impact of decades of saving, maybe accumulated wealth, or leveraging significant equity from selling a long-held home. But the crucial, empowering takeaway here, especially for younger listeners or first-time buyers, is that the data shows 9% to 10% is the median for your demographic, not that mythical, often impossible-seeming 20%.
Exactly. And what's even more important to understand is that even those median figures, 9% for first-time buyers, 15% overall, they aren't the absolute minimum required to buy a home. This is where we really hammer home the point. Many common loan types actually allow for much, much lower down payments, sometimes even zero, depending on your eligibility.
Okay, let's get into that, because this is another area where the 20% myth is not just wrong, but actively harmful, right? It stops people from even looking into these options. So what are the actual minimum down payment requirements for the common mortgage types available in the U.S.?
Bankrate, drawing on lender guidelines, lays this out very clearly. For conventional or conforming loans, these are the most standard types of mortgages, the ones that meet the criteria set by Fannie Mae and Freddie Mac.
Right, the standard ones.
The minimum down payment for those can be as low as 3%.
Just 3%. Okay, let's put that in concrete terms again, using our $400,000 home example. 20% down is $80,000. That 9% median for first-timers is $36,000. A 3% minimum conventional down payment on that same $400,000 home is only $12,000.
$12,000.
That is a massive, massive difference in the savings goal, from $80K down to $12K.
A truly transformative difference for many people's savings timelines.
Absolutely. Now, for adjustable rate mortgages, ARMs that are conforming, the minimum is typically a bit higher, around 5%.
Yep.
Jumbo loans, which, like the name suggests, are for loan amounts that exceed those conventional limits. They're for more expensive properties.
Right.
Because of the larger loan size and different market risks, jumbo loans typically require a higher minimum down payment. But even for these big loans, the typical minimum is often around 10%. Okay, so even for really large loans, the typical minimum is often still only half of that mythical 20%. That really underscores how much of an outlier the 20% figure is for required minimums.
Right. And then you have government-backed loans. These are specifically designed to make homeownership more accessible, often to specific groups or in certain areas, and they usually come with lower down payment requirements.
Like FHA loans.
Exactly. FHA loans, backed by the Federal Housing Administration, are really popular, particularly for first-time buyers or maybe folks with less than perfect credit scores. These require a minimum down payment of just 3.5%. Right. Now, they do come with mortgage insurance premiums both upfront and annual because of the lower down payment and potentially higher risk profile. But they open the door for many who can't meet those conventional minimums.
3.5%, another really low number. Okay, what about loans with absolutely no down payment required at all? Are those still a thing? Are they widely available?
Yes, absolutely. And they are a critical piece of the picture that just completely refutes the 20% myth. VA loans, backed by the Department of Veterans Affairs, are a significant benefit for eligible service members, veterans, and surviving spouses. These loans often require no down payment whatsoever, zero.
That's a huge benefit, a recognition of service.
It is a major financial advantage earned through service. And similarly, USDA loans, backed by the U.S. Department of Agriculture, also often require no down payment.
USDA, for farms.
Not necessarily just farms. These loans are available for eligible homes in designated rural and even some suburban areas all across the U.S. They're aimed at promoting home ownership in those communities.
Okay, so if you qualify based on your service history or the home's location is in an eligible area, you could potentially buy a home with 0% down.
Correct.
So we've got 0% for VA and USDA, 3% minimum for conventional, 3.5% for FHA. This whole spectrum of minimums from 0 up to maybe 10% for jumbos, it definitively blows the 20% myth out of the water. It's just not the reality of minimum requirements for the vast majority of mortgage options out there.
It really highlights that while 20% might have been, a historical preference or standard for some loans decades ago, or maybe it's still a preferred amount if you can swing it financially, it is by no means required by most common mortgage products available to buyers today. Knowing these minimums is really the first step in setting a realistic savings target for yourself.
Okay. Now, while you clearly don't have to put down 20% or you necessarily hit those median percentages we talked about, like 9% or 15%, are there advantages to putting down more than the absolute minimum if you can afford to do so comfortably?
Yes, there definitely are benefits. And it's important to understand these pros, provided that putting down more doesn't completely wipe out your savings or leave you without an emergency fund. That's key.
Right. Don't leave yourself house poor with no cushion.
Exactly.
Yeah.
Bankrate and other sources list several key advantages to a larger down payment, if it's feasible. First, and most simply, the less you put down, the more money you have to borrow. Conversely, putting down a larger amount means you have a lower overall loan amount.
And a lower loan amount directly translates to a lower monthly mortgage payment, right? Because you're financing less principal.
Exactly. Lower monthly payments. And not just lower payments today, but also lower total interest paid over the entire life of the loan. If you borrow less, you pay interest on a smaller sum for, 15 or 30 years. That can add up to tens, even hundreds of thousands of dollars in interest savings over the term of the mortgage.
That's a significant long-term financial benefit for sure.
It really is. Additionally, putting down a larger percentage can potentially help you qualify for a better interest rate on your mortgage.
Oh, interesting. Why is that?
Well, lenders often view borrowers who put down more as lower risk. You have more skin in the game, more of your own money invested in the home from day one. A better interest rate, even a fraction of a percent lower, can mean even more savings over time on those monthly payments and the total interest paid.
And I imagine it also gives you more immediate equity in your home right from the start.
Correct. You start with a larger ownership stake in the property right away. And this isn't just like an abstract number. This initial equity provides a financial cushion. It acts as a safeguard against potential declines in home value, which, while unpredictable, are always a possibility.
So if the market dips, you're less likely to be underwater.
Exactly. If your home's value were to drop, having substantial equity from the start means you're much less likely to end up owing more on the mortgage than the home is currently worth that underwater situation.
Okay. So while it's definitely not required, a larger down payment is certainly beneficial for your long-term financial picture, increases stability, it reduces borrowing costs if it's within your reach, without jeopardizing other financial goals or your emergency savings.
Precisely. The key is understanding the options and making an informed decision that balances the benefits of a larger down payment against the need to maintain financial liquidity and that all-important emergency fund. It's not an all-or-nothing decision based on the 20% myth, but a calculated choice based on your personal finances and risk tolerance, whether your target is 3%, 9%, 15%, or something else.
Okay, so we've thoroughly debunked the 20% myth. We've seen what people are actually putting down, often much less. And we've learned about the low minimum requirements for various loan types. This gives us a realistic target number to aim for. The next, and maybe the most challenging question for many listeners is, how do you actually save for that amount? Whether it's $12,000 for 3% down on that $400 K home or $36,000 for 9% down or whatever your personal goal is. What are the practical strategies and real-world tactics people are using to actually make this happen?
Right, the how-to. It absolutely starts at the foundation of personal finance, budgeting and planning. As advice from institutions like Burke and Herbert Bank emphasizes, you first need to determine your specific down payment goal, based on realistic home prices in your target area and the loan options you might actually qualify for.
Use those calculators.
Yeah, use online mortgage affordability or down payment calculators to help set that concrete number. Get specific.
Okay, figure out the target dollar amount you need to save. Step one.
Exactly. Once you have that goal amount, you need to create a detailed budget and a timeline. Analyze your current income and expenses. Really dig in to calculate how much you can realistically save each month towards this goal. This exercise helps you estimate when you might actually be ready to buy. Having that specific dollar target and an estimated timeline makes the goal tangible, gives you a clear path.
And concrete saving habits are essential, right? What's the absolute first practical step someone should take once they have that goal and timeline?
Establish a separate savings account, dedicated specifically for your down payment money. This is advice you see consistently, from financial experts to anecdotes on Reddit. Recommend a dedicated account that isn't your everyday checking account. A high-yield savings account, HYSA, is often a great choice. Or maybe even laddered CDs if your timeline is a bit longer and fixed.
Why is that separate account so important? Is it just psychological?
It's partly psychological, yes. It makes the money feel earmarked for that specific goal, less accessible for everyday spending or impulse buys, out of sight, out of mind from your main transaction account. But it's also practical. It helps you clearly track your progress towards that specific down payment goal. You see the number growing just for that purpose.
Okay, and the key tactical step?
Automate your contributions. Set up a direct transfer from your checking account to this dedicated savings account for a fixed amount each payday or each month. Make it automatic.
So you don't even have to think about it.
Exactly. Consistency is crucial, and automation removes the need for conscious effort each time. It makes it much less likely you'll skip a contribution or forget.
And you mentioned a high-yield savings account, a HYSA. What's the specific benefit there? Sources like NerdWallet talk about these a lot.
Right. The HYSA offers an interest rate expressed as APY, annual percentage yield, that is significantly higher than the national average for standard savings accounts you might get at a typical big bank.
So your money grows faster while it's just sitting there?
Precisely. Thanks to compound interest.
Ah, compound interest. The magic where you earn interest not just on your initial deposit, but also on the interest that's already been added, it starts growing on itself.
That's exactly it. It's your money making more money for you, passively. The APY is the key figure to compare when looking at HYSAs. It shows the total compound interest your money would earn over a year. Higher APY means your savings pot grows larger, faster, with less additional effort from you. NerdWallet has good resources on finding ones with competitive rates, FDIC insurance that's crucial to protect your deposit, and easy access when you need the funds for closing.
And we saw people on Reddit mentioning using specific HYSAs like Ally for exactly this purpose, appreciating those better returns.
Yeah, real people finding value in them.
Okay, so automate savings into a dedicated HYSA. That's foundational. But for many people, finding the money to put into that account in the first place, especially when living costs are so high, that's the biggest challenge, which often means taking a hard look at current spending and finding ways to cut expenses.
It absolutely does. And this is where real discipline comes in, as highlighted again and again in those Reddit stories. Burke and Herbert suggests starting with the bigger, fixed monthly expenses. Shop around. Get quotes for better rates on things like car insurance, renter's insurance, eventually homeowners, health insurance maybe, cable, internet, cell phone plans.
The recurring bills.
Yeah. You might be genuinely surprised how much you can save annually just by calling providers, comparing offers, maybe switching companies. These aren't small cuts sometimes. They can free up dozens or even hundreds of dollars a month that can go straight to that down payment fund.
Those are great places to find significant savings. What about the day-to-day stuff?
Absolutely critical. Monitoring and reducing discretionary spending. Use online banking tools, budgeting apps, whatever works for you, to track where your money is actually going, down to the dollar. Identify areas where you can realistically cut back, maybe not eliminate entirely, but reduce. Dining out, daily coffees, impulse shopping online, entertainment subscriptions you barely use. These are common leaks.
Little amounts that add up fast.
Exactly. The Reddit anecdotes were full of this. People talking about cutting back heavily on dining out, packing lunches every single day, buying fewer clothes, skipping vacations or expensive nights out for a while. One user described needing to be ruthless about finding money to save.
We also saw some pretty significant lifestyle adjustments mentioned in those real-world Reddit experiences, things that go way beyond just trimming the budget.
Yes, people shared some really powerful stories of the sacrifices they made. Things like living with parents or getting roommates for longer than they might have wanted, specifically to slash housing costs.
Yeah.
Driving an older paid-off car instead of getting a new car payment, even if the car wasn't, the coolest or most reliable. Temporarily moving to a cheaper apartment or even relocating to a lower cost of living area just to accelerate savings.
That's a big move.
It is. One person mentioned actively living like you're still poor, even after getting a raise or a better job, just funneling all that extra income directly into savings instead of letting their lifestyle creep up to match the new income.
Those are not easy choices. They require serious personal discipline, often putting parts of your life on hold temporarily. But they highlight the level of commitment some people are making to achieve this goal, and that these sacrifices, while tough, are often temporary and can lead to getting that home much faster.
And many of those who shared these stories on Reddit really emphasized that while the sacrifices were real, the feeling of finally reaching their goal, getting those keys, made it all feel worth it. It shows it takes serious work, discipline, perseverance.
What about the other side of the equation, boosting income? Cutting back only goes so far for some people.
Absolutely. That's another tactic mentioned frequently by those who successfully saved up. Things like saving tax returns as a lump sum instead of spending it. That could be a significant annual boost to the savings account. Similarly, directing work bonuses or any raises straight into savings rather than letting them get absorbed into regular spending. That's a powerful move.
Side hustles came up too, right? People picking up extra work.
Oh yeah, very much so. There was one anecdote on Reddit about someone waitressing specifically as a side hustle with the explicit goal of saving an extra $1,000 a month just from that additional income.
Wow.
Working overtime at their primary job is another common way people boost their income for this specific savings goal. Selling assets they no longer need, like a second car, collectibles, furniture, that was also cited as a way to get a lump sum for the down payment fund.
So it's often a multi-pronged approach for many people. Save more by spending less and earn more to speed up the process.
Exactly. A combination of careful planning, consistent automated habits, finding creative ways to save and earn, and maintaining significant motivation over time, often involving real sacrifices.
Okay, and what about debt? This comes up a lot. Should people focus on paying off existing debt like student loans or credit cards before or while they're trying to save for a down payment?
That's a really common question, and a lot of financial experts, echoing principles you hear from folks like Dave Ramsey or others, advocate for aggressively paying off high-interest debt first, particularly credit cards or high-interest personal loans.
Before saving or at the same time?
Often before focusing heavily on down payment saving, or at least tackling it very aggressively alongside minimal saving. The reasoning is simple. The interest rate on most credit card debt is almost certainly much, much higher than any interest rate you'll earn in a savings account, even a good HYSA.
Right. You're losing more money to interest than you're gaining. The math doesn't work.
Exactly. You're digging yourself out of a hole faster by eliminating that high interest debt. By paying it off first, you stop that financial drain, which then frees up significantly more money to save faster once the debt is gone.
Makes sense. You free up those monthly debt payments, whether they were minimums or extra payments, and that significantly increases your cash flow, your capacity to save once that burden is lifted.
Precisely. Whether you use the snowball method, tackling smaller debts first for quick psychological wins, or the avalanche method, focusing on the highest interest rate debt first to save the most money overall, the key is reducing those outgoing debt payments to maximize your ability to put money into savings later.
Less money going out to debt means more money available to go into that dedicated down payment savings account. Got it. And finally, saving this much money. It can feel like a really long, difficult journey. How do people stay motivated when the goal seems so far away and the sacrifices are hard?
That's a critical piece, the psychological aspect. Burke and Herbert suggested celebrating savings milestones. Don't just focus on the final number. Break the large, daunting goal into smaller, more manageable chunks. If you need, say, $30,000, maybe celebrate modestly every time you hit a $5,000 or $10,000 increment.
Like a small reward.
Yeah, a nice but inexpensive meal out, or something small you've been wanting. It helps you stay encouraged, visualize the progress you're making, and prevents burnout. The Reddit stories really underscore this too. It takes serious commitment, discipline, perseverance. But seeing that savings account balance grow, even slowly, and acknowledging those whims along the way can provide the necessary motivation to keep going.
Finding an accountability partner, maybe. Visualizing your future home.
Absolutely. Anything that helps keep the goal top of mind during those tough saving periods when you're tempted to splurge or give up.
It really sounds like a blend of rigorous financial planning, disciplined habit formation, getting creative with income and costs, prioritizing debt strategically, and importantly, maintaining motivation and perspective throughout the journey. But what if, even with all these strategies, someone still can't quite bridge the gap to reach their realistic down payment goal? Are there other resources available specifically designed to help people get over that final hurdle?
This is an absolutely critical point, and sadly one that many potential homebuyers perhaps still fixated on that 20% myth, or maybe just unaware, completely overlook. Down payment assistance programs, DPAs. They are designed specifically to help bridge that exact gap, reduce the amount of cash you need up front, and make homeownership accessible to more people. Sources like the Mortgage Reports and USAGov talk extensively about these.
Okay, DPA programs. How widespread are these? Are they just in a few specific cities or states, or is this a bigger resource?
This is the part that often surprises people. There are over 2,000 down payment assistance programs available nationwide.
2,000.
Over 2,000. They are not some niche thing. They are a significant landscape of resources run by state, county, and city governments, local housing authorities, nonprofit organizations. These programs can potentially provide thousands, sometimes even tens of thousands of dollars to eligible buyers to help specifically with their down payment and often closing costs too.
Over 2,000 programs across the country. Okay, so this isn't a small, obscure possibility. It's a major potential source of funds for a down payment that people need to know about. What kind of assistance do these 2,000 plus programs typically offer? What forms does it take?
They come in various forms, and understanding the different types is really important when you're researching. Probably the most attractive, the most straightforward for many are grants.
Grants? Like free money?
Essentially, yes.
Yeah.
Financial gifts that generally do not need to be repaid at all, provided you meet the terms, which usually involves just living in the home as your primary residence for a certain number of years.
Wow, okay. What else?
Another very common type is a forgivable loan. These are loans provided for the down payment that are forgiven over time.
How does that work?
Typically, if you remain in the home as your primary residence for a set number of years, maybe 5, 10, sometimes 15 years, the loan amount is gradually reduced or completely eliminated over that period. You would usually only need to repay the loan amount, or maybe a pro rata portion, if you sell the home, refinance your main mortgage, or move out before that forgiveness period is complete.
Okay, so that significantly reduces the burden of repayment as long as you're planning to stay in the home for a decent amount of time.
Right, it makes it much more manageable. Then there are low or no interest loans. These are also loans provided for the down payment, often structured as a second mortgage that sits behind your primary home loan. They have very favorable terms compared to market rates, sometimes even 0% interest. And repayment terms vary widely. Some might require small payments from the start, but many defer payments entirely until your primary mortgage is paid off, or you refinance the home, or you sell the home.
So you get the funds you need up front, but potentially without adding a significant extra monthly payment burden right away.
Exactly. The mortgage reports mentioned examples of programs offering 0% interest second mortgages with payments deferred until the home is sold or refinanced. It's incredibly helpful for cash flow in those early years.
These programs sound amazing. They exist specifically to help overcome that down payment hurdle. So how do you know if you might qualify for one? What are the typical eligibility requirements?
Right, eligibility is key. And it's crucial to understand that requirements vary widely from program to program because they're often locally managed. There's no single set of national rules. However, common criteria often include things like being a first-time home buyer, although some programs do serve repeat buyers too, having household income below a certain limit, which is usually based on the area median income, or AMI, for that specific city or county.
So it depends on where you live and how much you earn relative to others there.
Exactly. Also, meeting minimum credit score requirements, which can sometimes be a bit more flexible than conventional loan requirements, and purchasing a home within a specific geographic area or maybe below a certain purchase price limit.
So you absolutely must check the specific rules for programs available in the location where you actually plan to buy.
Absolutely essential. You need to do that local research.
And there are also mortgage credit certificates, or MCCs, right? Those provide assistance in a different way, through taxes.
Yes, MCCs are a really valuable related form of assistance that are available in many states. An MCC doesn't give you cash up front for the down payment itself. Instead, it provides a federal tax credit each year based on a portion of the mortgage interest you pay.
A tax credit, not a deduction, so dollar-for-dollar reduction.
Exactly. A dollar-for-dollar reduction in your federal tax liability, which means you either get a larger tax refund at the end of the year, or you can adjust your payroll withholding throughout the year to pay less in taxes each paycheck.
So it's not money for the down payment itself, but it effectively reduces your tax burden annually, freeing up money that could then be used for housing costs or maybe put back into savings.
Precisely. For example, if you pay, say, $5,000 in mortgage interest in a year, and you have an MCC for 20%, you get a $1,000 federal tax credit. That's $1,000 you don't owe in taxes, money you can then use elsewhere.
How do you get one of those?
The mortgage reports mentions these are available in several states. You typically need to apply for the certificate when you get your mortgage through an approved lender, and then you claim the credit each year when you file your taxes using IRS Form 8396.
Okay. It sounds like actively researching these local and state down payment assistance programs, and maybe MCCs too, is a crucial early step in the home buying process, something that could significantly impact your savings goal and timeline.
It absolutely is. Many Reddit users who successfully bought homes mention finding programs through their state's housing finance agency website or by searching their specific county or city government websites. Look for housing departments or resources. Several also noted that having the right lender, one who is knowledgeable about and experienced with navigating these various DPA programs or doing your own thorough research, is key to actually accessing them. It's not always straightforward.
That really highlights the critical role of information and maybe who you trust for guidance in this complex landscape.
Definitely.
And speaking of information and trust, the way people, especially younger generations, are getting information about homeownership seems to be changing pretty rapidly. And it ties directly into what we've been discussing about busting myths and knowing your options.
Yes. The 2025 Next Gen Homebuyer Report from National MI and First Home IQ offers some really fascinating and maybe a bit concerning insights into this shift. It looks at how younger buyers, specifically Gen Z and millennials, are conducting their home buying research and who they trust. And the report shows a definite movement away from relying solely on traditional established sources.
Okay, so where are younger buyers turning for their information then?
Well, social media is a significant source. 40% of Gen Z and 30% of millennials reported using platforms like Instagram, TikTok, YouTube for home buying research, getting tips on saving, mortgages, finding properties.
40% of Gen Z using social media for this. Wow.
Yeah. And even more interestingly, AI tools like ChatGPT are being used by a substantial portion. 35% of all next-gen respondents use AI for information, led strongly by Gen Z at 43%.
43% of Gen Z using AI tools like ChatGPT for home buying info. That's remarkable and speaks to a fundamental shift in how people are seeking knowledge.
It really does. It shows a comfort and willingness to embrace newer technologies in the research process. Now, friends and family are still the top preferred source overall at 57%, showing the enduring power of peer advice.
Okay.
But traditional professional sources like financial advisors, preferred by only 36%, or simply reading online articles preferred by 42%, they're less dominant than you might have expected compared to these newer, often less vetted channels like social media and AI.
And this report also found some quite concerning data points about declining trust in those traditional financial institutions and professionals, didn't it? Which probably fuels this shift towards peers, social media, and AI.
That's a major critical finding from the Next Gen report.
Mm-hmm.
And it's something anyone providing guidance in this space really needs to grapple with. Trust in financial institutions overall has dropped significantly among next-gen buyers, from over 61% down to just 40% in a single year. That's a steep drop. Trust in loan officers specifically is particularly low, standing at only 19.5% among these buyers.
19.5% trust in loan officers. That number is startlingly low. It suggests deep skepticism.
It does. And trust in realtors is also relatively low, with only 33% of next-gen buyers believing they provide reliable, unbiased guidance.
Why such low trust?
Well, the report links it to a broader societal trend of increased skepticism and distrust across various sectors, mirroring findings in big trust surveys like the Edelman Trust Barometer. Whether this distrust is entirely warranted or partly a symptom of misinformation online is complex. But the reality is, buyers don't inherently trust these traditional sources as much as they used to.
So what are the practical implications of this widespread distrust and the shift to non-traditional info sources for someone trying to buy a home?
It means buyers are much more likely to bypass, or at least significantly supplement, traditional professional advice from lenders and realtors with information they get from peers, social media, online forums, AI. Remember, only 20% trust loan officers for smart mortgage decisions. Only 33% trust realtors for reliable guidance. This suggests that even when buyers are engaging with professionals, they may be cross-referencing everything or relying more heavily on outside information to validate what they're being told.
Which could be good doing your own research, but also risky if the outside info isn't accurate.
Exactly. It fundamentally reshapes how financial decisions are approached and highlights the risks of potential misinformation from unverified sources proliferating online.
And does this low trust and reliance on diverse sources connect back to the lack of formal financial education many people receive? Did the report touch on that?
Absolutely. The report found that over half, 53% of NextGen received no formal financial education in school. Another 29% had only optional or very short lessons.
That's a huge gap.
It's a significant gap. Buyers may not have the context or the critical thinking skills needed to properly evaluate the information they find, whether it's from a professional loan officer or a random TikTok video. It contributes to the knowledge gaps and the confidence issues observed, particularly among Gen Z and women, making them potentially more susceptible to misinformation or just feeling completely overwhelmed by the whole process.
It paints a picture where people are really hungry for reliable information about complex financial topics like home buying, but maybe haven't been given the tools or perhaps lack trusted guides to find it effectively, leading them to these less traditional, sometimes less reliable avenues.
Precisely. And for the housing and financial industries, this trust deficit and this shift in information seeking present both a major challenge and, potentially an opportunity. The report suggests that rebuilding trust requires, unprecedented levels of transparency, truly personalized communication that addresses individual concerns, and accessible education tailored to how people actually seek information now.
Meeting them where they are.
Exactly. Meeting them on the platforms they use, with content that is authentic, clear, easy to understand, and demonstrably trustworthy.
It's about recognizing the reality of where people are getting their information and working hard to provide trustworthy, clear guidance within that landscape, rather than just expecting everyone to default to traditional channels they may not trust anymore.
It's about empowering buyers with knowledge, respecting their preferred learning channels, and actively working to rebuild that confidence that is clearly eroded, proving that reliable guidance is available.
Okay, so let's bring this all back to you, the listener. You started this deep dive, perhaps feeling pretty daunted by that idea of needing 20% down. We've covered a significant amount of ground today, pulling insights from data, reports, real-life experiences. We've seen definitively that the 20% down payment is largely a myth that is, unfortunately, holding many people back unnecessarily from even exploring homeownership.
We've learned that typical down payments, especially for you first-time buyers out there, are often much, much lower than that mythical figure, closer to that 9% to 15% median range, not 20%. And even those medians aren't the absolute minimum.
Crucially, we've explored that minimum down payment requirements for common loan types can be as low as 3%, 3.5%, or even 0%, depending on the loan you qualify for, conventional, FHA, VA, USDA. This dramatically lowers the barrier to entry in terms of the upfront cash needed compared to that intimidating 20% figure.
We've highlighted that while saving for a down payment at any level requires discipline, careful budgeting, potentially cutting expenses, maybe boosting income, and sometimes making significant sacrifices, like we heard in those powerful real-world anecdotes from Reddit. It's absolutely achievable. Millions of people are doing it.
And perhaps most empowering, we've shown that there are literally thousands of down payment assistance programs available across the U.S., offering grants or favorable loans, sometimes forgivable, sometimes deferred payment, specifically designed to help you bridge that savings gap and make homeownership more accessible.
We've also touched on the changing landscape of information and trust, underscoring the need for you to be proactive, to be discerning in seeking out accessible, transparent, and reliable guidance as you navigate this complex process, given that widespread skepticism towards some traditional sources.
So what does all of this mean for you personally on your journey towards potential homeownership? Well, the first practical step, armed with this information, is to figure out your own realistic target goal. Based on actual home prices in the areas you're considering and the potential loan options available to you, remembering those minimums of 0%, 3%, 3.5%, and that typical first-time buyer median around 9%. What is a down payment number that feels challenging? Yes, but achievable for you. Don't default to 20%. Maybe it is $12,000 for 3% down on a $400,000 home in your area. Maybe it's $36,000 for 9% down. Set a specific, data-informed, realistic dollar amount target for yourself.
Then, immediately take action on the saving strategies we discussed. Create that detailed budget and timeline. Set up that separate high-yield savings account today and automate a monthly contribution, even if it's small to start. Look ruthlessly for areas to cut expenses. Explore options to boost your income. Strategically address any high-interest debt that's holding you back. Every single dollar saved, consistently and automatically, gets you closer.
And crucially, right alongside your saving efforts, immediately start exploring those down payment assistance programs available specifically in the state, county, or city where you plan to buy. Don't wait until you think you have enough saved or until you talk to a lender. Learn about these programs early. Understand their eligibility requirements. See how they might impact your realistic target goal and your timeline. Check official government websites, state housing finance agencies, and look for lenders who are experienced and knowledgeable in helping buyers actually utilize these programs.
Look, saving for a down payment might feel like an uphill battle. The scale of the numbers can be intimidating, especially with that pervasive, outdated idea about needing a full 20%. But as we've seen from the data and the real-world experiences, the path to homeownership rarely starts with that massive, discouraging figure for most buyers today. It's much more about setting a realistic, data-backed goal, developing a disciplined saving strategy, one that often involves real sacrifice, yes, but is achievable. It's about leveraging the many resources available, like those DPA programs, and knowing where to find accurate information tailored to your specific situation in today's complex landscape.
So the question for you is, what specific resources will you tap into and what concrete discipline strategies will you adopt starting this week to make your realistic homeownership goal a tangible reality?
Thanks for joining us for this deep dive into navigating the down payment hurdle.
We'll catch you on the next one.